Ladies and gentlemen, good day and welcome to the Symphony Limited Q1 FY23 earnings conference call, hosted by Investec Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions at the end of today's presentation. Later, we will conduct a Q&A session. At that time, you may click on the Raise Hand icon or Q&A tab on the meeting. Participants connected on the audio call may enter star and 1 to ask a question. Please note that this conference is being recorded. I now hand the conference over to Mr. Aditya Bhartia from Investec Capital. Thank you, and over to you, sir.
Thanks, Inba. Good afternoon, everyone. On behalf of Investec, I would like to welcome you all to Symphony's Q1 FY23 results conference call. We have with us the senior management team of Symphony Limited, represented by Mr. Achal Bakeri, Chairman and Managing Director, Mr. Nupesh Shah, Executive Director, Corporate Affairs, and Mr. Amit Kumar, Executive Director and Group CEO. I would now like to hand over the call to the management for their comments. There's a presentation which the management would be running through, the link of which was put in the calendar invite. Thank you, and over to you, sir.
Thank you. This is Achal Bakeri. Good afternoon to everybody and welcome to the call. We will jump straight into the presentation which our Executive Director, Mr. Nupesh Shah, will be making, post which we will take all the questions. Thank you.
Hello, good afternoon to everybody. This is Nupesh Shah. We have already shared the link if you wish to connect so as to refer the presentation, because there will be certain graphs and data. So to start with, customary safe harbor statement applies in the respect of forward-looking and expected statements. So 27-degree world, that is the space in which we are operating. That is the comfortable cooling around the world. We are very pleased to announce that so far, Symphony and its subsidiaries have cumulatively sold in excess of 25 million air coolers in the country and globally, and almost 1/3 of it is out of India. So that signifies the scale, size, and potential not only within the country but globally. So now coming to performance highlights for June 23 quarter. So after 2 COVID summer and COVID years, finally we are back to normal quarter, and in June 23 quarter we have registered highest ever standalone as well as consolidated sales. Vis-a-vis earlier highest June quarter, on a standalone basis, we have registered almost 30% higher top line, while on consolidated basis, it is 13% higher. And very importantly, this is on top of and despite unprecedented highest ever pre-season channel inventory, mainly on account of COVID-19 in 2 previous seasons. So if we consider the customer sales during the quarter, it should be even at a purchase price of distributor around or in excess of 700 crore. And finally, at the end of the season, we are back to normal channel inventory almost across the country. Also, very importantly, whatever work we have done in last couple of years, which we highlighted and shared in the past, despite unprecedented increase in input cost as well as freight costs, on a consolidated basis as well as on a standalone basis, our gross margin is higher than pre-COVID quarter, that is June 19. However, standalone as well as console EBITDA are lower compared to June 19. In fact, most of the comparison we have made vis-a-vis pre-COVID quarter, because obviously last 2 years quarters were low base, and hence even internally we are not comparing in terms of our performance. So EBITDA margin is lower, one, because we have incurred higher advertisement and promotion expenses not only in June 23 quarter but also in earlier quarter as reported earlier. One, to sell historically highest pre-season channel inventory as well as newer initiatives, mainly D2C and also e-commerce promotion. And in addition to that, as it is known, very high increase in freight and forwarding charges, and also to an extent there has been change in warranty estimate as per the accounting standard. And EBITDA margin has also partly impacted because, as it is known, in D2C initially, apart from advertisement, the cost below gross profit in respect of the fixed overheads as well as initial establishment expenses are also higher, and to an extent that is applicable to e-commerce also. And as it was expected, D2C and e-commerce both have generated robust incremental sales growth. We are also happy to announce that we have initiated, of course with the baby step, globally D2C as well as e-commerce in USA, Mexico and Australia. And we expect that in medium term, they have a huge potential on account of not only global presence, but more importantly, we do have full-fledged operational subsidiaries with a large team, also having Symphony-owned, local, well-known, decades-old established brands and global models suitable to respective territory. Large space ventilating cooler, which was earlier known as ducted and centralized air cooling, has generated robust traction on account of some of the initiatives which were taken just before COVID set in, and also in last 2 years, that is new models, wider distribution network and localization of product manufacturing, which allowed us to offer affordable and competitive prices.
तुम्ही ज्या व्यक्तीशी बोलत आहात त्याने तुमच्या कॉल
which has allowed us not only to offer affordable and competitive pricing, but still to maintain very robust profitability margin in that segment. Symphony has been bestowed with Great Place to Work certification, and we are attracting and nurturing the brightest talent across the department at all the level, and that is helping us to evolve into strong business leaders. And now as normalcy is back, so even in respect of payout also, we are back to normalcy and we are back to quarterly payout. So we have announced first interim quarterly dividend of ₹2 per share, that is about 14 crore. So coming to consolidated financials, June 23 quarter registered 329 crore of sales, that is 43% vis-a-vis June 22 and 13% higher than June 20, that is pre-COVID quarter. The gross margin percentage during June 23 is 45.6 on a consolidated basis versus 45.3 in June 20.
That is June 19.
June 19, I'm sorry. It is June 19. However, EBITDA margin is lower by about 2.4% and stands at 10.5%. And PAT margin is lower at about 8.9%, partly on account of lower EBITDA margin and partly also on account of lower treasury income. So this has been the EBITDA margin movement in June 23 versus June 22 versus June 19 quarter. So as it can be seen, advertisement and promotional expenses higher by 1.3% despite higher sales, that is up from 31 crore to 39 crore due to reasons as explained earlier. And similarly, other expenses, mainly freight and forwarding and warranty charges, higher from 11 to 19 crore. So during the quarter, the geographical segment wise, total sales 329, out of which domestic sales 188 crore, that is 57%, while the rest of the world, including exports from India and sales by our subsidiaries 141, contributing to 43% of the top line. And as it can be seen on a right hand side chart, EBITDA margin percentage is also proportionate to geographical segment, that is 44% EBITDA margin from rest of the world and 56% from India. Coming to capital employed in core business, that is air cooler and appliances, during the quarter, the capital employed stands at 413 crore versus 288 crore in June 19 quarter. This is mainly on account of augmentation of some inventory and continued production even in June quarter to cater off-season requirement and also high sales to LFS and e-commerce, on account of which quarter end receivables, which by and large have been realized during current month. And ROCE percentage for 3 months for June 23 stands at 9%, that is annualized about 36%, while return on net worth on trailing 12 months profitability stands at 18% on a net worth of 818 crores. Coming to standalone financials, that is Symphony India, the top line is 208 crore, that is 30% higher than pre-COVID quarter and almost twice of June 22. Treasury income is down to 4 crore versus 7 crore in June 22 and 10 crore in June 20. And hence that translates into 1.9% of the revenue, which was earlier 6.2% of revenue, which has partly contributed to lower PAT percentage. Gross margin percentage on standalone stands at 50.6 versus 47.6 in June 22 and 50.1 in June 19 quarter. And EBITDA margin is down to 12.8%, while PAT stands at 25 crore, that is 12.2%. And the EBITDA shown earlier is purely from business, excluding treasury income. And on standalone basis, the EBITDA margin movement in respect of advertisement and sales promotion, it is up from 28 crore to 38 crore despite higher sales, and still percentage is higher on account of reasons explained earlier. And similarly, freight as well as warranty charges higher from 8 crore to 15 crore, so almost 2% higher. And on standalone basis, capital employed stands at 130 crore, translating into ROCE percentage of 19 for 3 months, that is annualized about 76%. And return on net worth percentage on trailing 12 months earning is 16% on a net worth of 808 crore. While treasury stands at 539 crore as on 30th June, almost in line with June 19 quarter. Coming to way forward, now there is a decent visibility of consumer sales in the domestic market on account of robust trade sentiments, uptick in consumer demand, and also that is reflected in off-season collection. We continue to plow the investments, which is mainly in terms of the revenue expenditure in domestic and global D2C as well as e-commerce platform, and also continuously leveraging new age technology and tools for products as well as internal processes in the domestic market as well as internationally. So we are keeping a close watch on evolving global headwinds, which may translate into demand headwinds in some of the overseas markets. But still, we are reasonably well placed. Mainly on account of we are in a position to leverage our Indian as well as global outsourced manufacturing facilities and very agile supply chain strategy. Just to give an example, we used to earlier manufacture plastic air coolers for Mexico in India, but on account of high logistic costs, in a very short period, we could shift our molds in Mexico and started local outsourced manufacturing facility, and similarly for some of the models being sold in Australia. And as and when tide turns, we can easily reverse that. So we are pursuing in letter and spirit ESG agenda. So we have carried out detailed ESG assessment, and it has come out that Symphony products generate 93% lower GHG emissions vis-a-vis 5-star air conditioner. And on an average, one Symphony air cooler saves approximately 7 trees over its useful life, a great contribution to the earth. And finally, this is shareholders profile. So we are open to Q&A.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Participants connected to the presentation link, if you wish to ask a question, you can click on raise hand icon available at the toolbar on the bottom of your screen, or you may click on the Q&A icon to raise hand. An operator will take your name and announce your turn. Participants connected via audio call on a telephone may enter star and 1 on their touchtone telephone. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Manoj Gori from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity and good evening, everyone. My first question is, so if you look at the situation at the ground level, definitely there has been some pressure across product categories. So has it impacted sentiments of channel partners which might resist them to build inventories during 2Q and 3Q? And if you can some broad indication, like broad trend, how the July collections have been, that would be helpful.
Manoj, could you repeat your question? We were not very clear.
Am I audible? Am I better now?
Yeah, better.
Yeah. So what I meant was situation at ground level definitely seems to be some stress on the consumer demand, especially from the June month onwards. Has it impacted has it impacted sentiments of channel partners, and accordingly they might resist on building inventories during 2Q and 3Q? Also, if you can share how the July collections have been.
No, so as earlier shared during the presentation, in fact that's not true, at least for our product, and it's clearly reflected in our July month season collection, and it is in line with our business plan. That's
Okay.
number one. And number two, importantly, many trade partners to an extent had low confidence pre-season due to back-to-back 2 COVID summer. But that has been completely restored and there is a fresh interest. And in the past, we have seen that when it comes to air cooler, it has no correlation with the economy. In fact, if you recollect, during 13-14 to 17-18, when the economy was not doing that well, or there were many black swan events, in fact, Symphony continued to perform exceedingly well. The only correlation is with the weather.
Right, understood. So secondly, if you look at the gross margins, we have reached 50% mark after roughly around 8 quarters. Going forward, can we expect, given that the cost pressures were very severe during 1Q, could we expect normalized margin levels for the domestic business for the rest of the year?
No, so we will keep a close watch on input costs, and we will decide whether to improve the margin or to take some strategic decisions. But as you would have observed that in June 19 there was no cost pressure, and in June 22 quarter, whether on console level or on a standalone level, we have maintained the margin.
Right.
And obviously that is on account of various factors and initiatives which we have done successfully.
Okay. So on the subsidiary gross margin, so if we look at console minus standalone, your gross margins for the subsidiary businesses on sequentially has been impacted significantly. So probably if you look at this has been the lowest gross margins for last 8 to 9 quarters. And despite all the efforts that we have taken. So how should we read this given that now the RM prices are cooling off and have cooled off significantly? So can you throw some light over there?
As far as subsidiaries are concerned, that's why in our geographical segment, below quarterly performance, we had also shown in respective year and quarter how the margin moved. So actually 1 quarter performance is nowhere reflecting that. If you can see that slide has been open. So in FY22 Q1, that is June 21 quarter, corresponding quarter of last year, subsidiary EBITDA margin percentage was -5. But year as a whole, it registered 51%. Point is, subsidiaries performance most of the times has been skewed to December quarter and March quarter. And by and large, we are confident that in the current year also, we will replicate what we achieved last year.
Right, sir. So one last question. So now if you look at, so obviously you already highlighted like you will take a strategic call on whether to maintain the gross profit margins and all for the domestic business. So suppose today if someone is buying, obviously he would be buying relatively at a lower price, a channel partner buying a air cooler. So probably if you look at in future quarters, probably the RM prices would be lower and your manufacturing cost would be lower. So in that case, if you maintain your gross margin to the normalized level, so how should it impact the purchase price of your channel partner?
Neither our channel partners will be impacted nor we will be impacted, and that has been our track record in the past. So there are various ways and means to do that.
Right, sir. Thanks a lot.
Thank you.
Thank you. We'll take a next question from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah, hi. Good evening, team, and congratulations for the result. My first question, yeah, thank you, sir. So my first question is, if you look at the India business, as numbers are broadly at the standalone level, sales are almost back to, domestic revenues are almost back to June 19 levels at 188 crores. But if you look at the impact of inflation and the price hikes, although not much were taken during the current fiscal, what in your view would be the volume growth over the pre-pandemic and the current levels from the market perspective?
So can you put up the volume growth? So first of all, Renu, congratulations to you too.
Thank you so much.
Yeah. So we heard you got married, so that's great. So as far as price hike is concerned, we really haven't taken much of a price increase as we have said in the past. So off the top of, do we have our volume numbers readily available? So there is so we have a significant increase in volume as well. We don't have it readily available. There is a significant increase, very much a significant increase in the volume numbers, no doubt about that.
And Renu, yes, as we shared from time to time earlier, due to strategic reasons, we didn't take actually much of the price increase. Even in June 22 quarter, we have taken very selected price increase, varying from model to model, and no way matching to input cost and freight cost increase. And as we shared earlier, that itself is one of the major our competitive mode, because there are several ways and means, including product mix, including high value models, enhancing the dealer distribution network, and spreading across the channels. So essentially, they were the ways and means. And also, we need not to forget, as shared earlier, massive work done by our operating team in terms of value engineering and also to an extent cost rationalization. So it's a contribution, in fact, collective efforts of all this.
But Renu, your point is, what I believe what you're trying to get to is whether the increase in revenue is because of price increases or because of volume increases. It is,
right. Broadly, on a 3-year basis, revenue numbers, India revenues look flattish. So there would be some volume growth given the changes in mix which would have been there.
Absolutely. Absolutely.
And Renu, this June 22 quarter sales is in addition to channel inventory, which had piled up substantially, isn't it? So channel inventory got cleared off substantially, and channel inventory sales value was substantially higher than June 22 quarter.
Correct. Got it. So secondly, if we look at your comments, you did mention that there has been a meaningful and a visible turn in the sentiment of the trade partners after the current season. So when we look forward towards FY23, where the off-season booking would have started for you, should we expect a similar kind of jump up in growth the way we have seen in the historical trends, where growth tends to be 30-40%? Given last year we had a low inventory upstocking during the off-season, plus there was inventory channel also which was there. So if you offset both of these elements, then at least the core domestic revenue growth numbers or the outlook, would it be right if we assume it should be fairly strong even in the current environment?
I mean, the initial indications, and we are now we are sort of nearly a month into the off season and into the sort of the new business year. The initial indications or feelers that we get from the trade are very, very upbeat. So, well, I wouldn't we wouldn't get into specifics. You mentioned 30-40%. We wouldn't, dare get into specifics, but we are internally tremendously enthused by the response we are getting, and we expect that we will end the year. We should sort of revert back to our historical sort of growth trends.
Got it.
And Renu, after turnaround of our international business in FY22, now we look at and also urge all the analysts to look at console numbers, because console EBITDA margin is in line with domestic margin and amount wise also. Right. So that also matters a lot.
Got it. So if I look at the console numbers now, from the same context, and we derive the performance of subsidiaries, sequentially there is a visible shrinkage in the gross margins and the EBITDA margins for the subsidiaries. I appreciate there would be a change in the sales mix also between the regions, US market and the other regions, but if you can help throw some light on how the three key subsidiaries for you, both Mexico, China and Australia, how have they performed in terms of operating profitability, that would be helpful.
So, as I mentioned earlier, for subsidiaries, importantly, it should be seen year as a whole, and especially two significant subsidiaries, that is Climate Technology and IMCO. They are more skewed to, particularly Climate Technology, December quarter and March quarter.
Correct.
So, this no way signifies the annual performance, that's number one. And as shared in earlier slide, last year in fact, subsidiaries performance was not much impacted, and still in June 21 quarter, they contributed -5%, and still year as a whole, they contributed 51% of total EBITDA TT, isn't it? While current year, they have contributed in June 22 quarter almost 44% of EBITDA TT.
Correct. Sure. And lastly, any comment on the industrial part of the business, industrial cooling portfolio? How has that fared, given that it was a seasonal quarter for that business as well? LSP portfolio.
So, Renu, LSP business continues to be built, and now, as we are saying this season, we are getting into normal business mode. So, LSP business also is continuing to grow on lines of our expectations. We are not at liberty to disclose the absolute numbers at this point in time, but I would just add that the growth is in line with what we had planned, and we are seeing traction now in the market in both the commercial as well as industrial segments.
Sure. Thanks much, sir, and all the best. I have a couple of more questions. I'll get back in the queue. Thank you.
Thank you.
Thank you.
Thank you. A reminder to our participants. Participants who are connected via telephone call may enter star and 1 to ask their question. Participants connected via the presentation link may click on the raise hand icon to ask a question. We'll take a next question from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
Sir, thank you for taking my questions, a couple of them. So firstly, if you can give a sense, particularly in this quarter, when I look at the overall numbers, one of the things that I want to understand slightly in greater detail is the performance of climate technologies in context of it exporting to Home Depot in the US. Now with US likely to see some slowdown in consumer spending, and I understand, in our last conversation you were very gung-ho about that business. Any pressures you are already seeing on that particular piece? That's question number one.
So, Pulkit, what we are currently seeing is that the US is undergoing a sort of a record summer, so the sellout is pretty good. But the inflationary trends and the recessionary trends are sort of putting pressure on the selling price. So our customers have to resort to discounts, and which obviously is something that we as a company have to absorb. So the prices at which the retailers are able to sell this year are lower than what they were able to sell in the summer of 2021. So in terms of volume, thanks to the temperatures, we're not really seeing much of an issue. But for sure, the recession, is playing a role in the consumer's ability or willingness to pay. So we have to see how the rest of the year, sort of progresses. But if the recession is here to stay, then next year too, probably volumes may not be as badly affected as probably margins or selling prices could be.
Understood, sir. So my second question is on...
It may be offset by rupee depreciation, because as on 31st March 21, rupee was 73 and now it is 80, so about 9%. So to an extent, we may have competitive advantage to offset that.
Fair point, sir.
We don't have much of a competitive advantage, but when we convert to rupee, this thing may not be a significant reduction. Yeah.
I get that. Got it. So secondly, if you could talk about competition, any rough sense you would have in this particular quarter, any shifts in market share or what is our growth relative to the broader sector? Any sense on that, if you could talk about?
And I assume you're talking about India.
Yes, India only.
Right. So, the quarterly market share numbers are not yet out, and we are awaiting those. But the sense that we are getting from our channel partners and from our teams in the field is that our market share is, I would say, fairly intact. Maybe a shade higher, but there is no significant shift in the market share.
Understood. And sir, just one last question, more of an observation. I mean, given the fact that we've not really taken meaningful price increases, and now we are heading into a period presumably where costs have started coming down, already got elevated A&P spends and logistics cost in the quarter. So even if we don't take any major price action, would it be fair to assume that our gross margins as well as EBITDA margins from here should actually go north, unless there is, something that changes in the international business, as you highlighted, the various developments that are happening? Is that a fair observation, just on a steady state basis?
I think we should, separate this into two parts. One is at the standalone level. The price increase that you referred to really, is more relevant for India numbers. I think although we have not taken a significant price increase now so far, but in the current year, as we speak, we have taken, somewhat of for the next for the year to come. So we already actually put into effect a price increase, and you're right that with a price increase and with commodity prices or input prices likely to soften, the margins should look better than they did. However, there are too many, I would say, uncertainties going forward. So let's not get ahead of ourselves. Let's hope for the best. But what you say is a likely possibility.
Sure, sir. Thank you for answering my questions and best of luck.
Thank you. Our next question is from the line of Manish Poddar from Motilal Oswal. Please go ahead.
Hi, sir. Thanks for doing the call. So just one question. What is the change in accounting estimate for the warranty expenses? Can you please explain that?
Can you repeat your question again?
So what is the change in accounting estimate for warranty expenses? Can you explain that, please?
Can you explain, Girish?
So warranty is provided as per the accounting standard on the historical movement. So we have to take out the ratio of the past 2-3 years. So according to that, the provision has increased by 0.50% in this quarter. So provision is higher compared to June 19 and the June 21.
No, so this is a management estimate of the warranty expenses which you do. Let's say I think 18 crores was spent in FY20.
Correct.
So this is the management estimate of that.
Management estimate as per the historical warranty cost of the last 2-3 years.
Got it. Great. Thanks.
What about provision rather than
Yes.
Thank you. We'll take a next question from the line of Amit Mahawar from Edelweiss. Please go ahead.
Hello, Mr. Bakeri. I just have one question. If I club your last 2 quarter results, the standalone performance at 4.6 billion top line seems to be a significantly better number if I compare, say, last 3-4 seasons of clubbing of these 2 quarters. Effectively around 15% CAGR on a 6-monthly basis. So maybe you try to answer that in the previous question, but generally if I see your volume market share, I don't know if it's feasible for you to give it this to us, but do you think your volume market share would have headed north by a couple of percentage, sir? That's my first question.
So as we said earlier, the detailed market share reports for the June quarter are yet to come in. But basis our estimates in the markets and inputs from the channel partners, we believe we are broadly there, maybe a decimal point here or there on the higher side, but not major changes in the market share on the volume side as well.
Fair point. So the second and last question is again on standalone. The profitability of our business, the gross margin that we earn, the design engineering, advantage that drive our SKU rollouts. Do you think the overhead basically to retain the market share, and I'm not talking about freight and other costs which are more common to everybody, but more to maintain our competitive rigor. Do you think the ASP that we do, again I understand Q1 should not be seen because Q1 is where you incur bulk of it, but for the year as a whole, do you think the cost of retaining market share or slightly improving market share is coming very high? If you can address this question qualitatively, sir. Thank you.
So that's a valid question, Amit. And the way we would want to highlight this is, if you noted, we said earlier also that the ratio of our primary sales this year to the secondaries and tertiaries that have happened in the market, because of historical stocks there in the market, that ratio is a bit skewed. So obviously going forward, this ratio is likely to improve. We would think of this more as a one-time blip to correct the stock situation in the market rather than something which is structurally shifting on towards the higher side.
And having said that, further to beef up D2C and e-commerce initiatives, still it is an initial time. So there we spent in March quarter, June quarter, and we may have to spend, even though many of them may give long-term benefits, but by way of advertisement, initial establishment, team costs, many IT costs related initiatives, etc.
Fair point, sir. Thank you. Can I sneak in one last question if you allow, sir?
Yeah, sure.
Sure. This is on the subsidiaries. Generally, Q4 and Q1, if you see, are seasonally, again, volume-wise or revenue-wise strong quarters. Again, you try to answer this question in the last participant's query, but still, at least I'm not able to understand if Q4 and Q1, you are able to build more revenues in subsidiaries also in line with what you have in standalone. Generally, the profitability mark should be healthy. I'm sorry for this, but I'm not able to understand the profitability matrix in Q1 in subsidiaries, so why it's so much skewed.
No, how you are saying it is skewed because subsidiaries have contributed, I believe, about 45% of the top line, and in total EBITDA TT also they have contributed almost proportionate. So subsidiaries have contributed about 43%. There is 141 crore out of top line of 329, and out of 34 crore of PAT, they have contributed EBITDA. I'm sorry. Out of 34, contributed 15 crore. That is 44%, which last year was -5.
Okay. No, I was more referring to. No, so I was more referring to Q4 and Q1 top line of 1.3 and 1.2 billion. I mean, again, June quarter and March quarter. And if you see the cost index, generally the RM cost that we have in this quarter, that was not very clear to me why, there was a very different number vis-a-vis Q4. So why should Q4 and Q1 gross margin be very different is maybe my question. Thank you.
No, because in Q4, business is skewed to USA, while in Q1, there is a negligible USA-based business. Even in Q3 also, there is a relatively large USA-based business. And their margin percentage is very high. And that is how, by and large, it's likely to continue because their sales happens before their summer starts.
Right. Fair point. Thank you very much and good luck, sir.
Thank you.
Thank you. Our next question is from the line of Onkar Gangardre from Shree Investments. Please go ahead.
One question is regarding you have been consistently talking about utilizing your funds by the way of buyback, which hasn't materialized. So can you throw some more light on that, a concrete one?
No, so first and foremost, we have a stated payout policy of 50% of PAT that continues whether in form of dividend or in any other form. And obviously last 2 years there were a lot of uncertainties, so it was not an opportune time, and still we continued with the dividend payout, and as stated earlier, maybe now sooner than later we will resort to buyback. But there has to be an opportune time also, but I think it should be sooner than later.
What's stopping you from doing the buyback is the size or what exactly it is? I can understand last 2 years were not that great. I mean, the situation was that.
We can't preempt the board decision because ultimately the size, pricing and timing, ultimately board has to collectively decide. But overall sense what we get is it should be a decent permissible size, which I believe is up to 25% of the net worth, which as we just saw is in excess of 800 crore. So permissible size is around 210 crore or so. So the size seems to be permissible size or around that.
The next question is regarding.
And secondly, in the respect of buyback, we are also quite aware that there is some conflict between institutional investors and non-institutional investors, because institutional investors' preference is dividend, and as you know, almost 60% of our floating stock is owned by institutional investors, and non-institutional investors do prefer buyback, so we have to also manage that balance well.
Next question is regarding the channel inventory which you talked about is almost back to normal. So, given taking into consideration that, how do you see a couple of quarters performance of yours?
As we said earlier, the channel inventory seems to be reaching the regular pre-COVID normal level, and with that context and with the experience of the coming season, we do anticipate and hope that the coming couple of quarters would be in line with our historical growth pattern. At least signals coming from the July collections are also pointing in the same direction.
And what about the international markets?
The international market typically had a much smaller outstanding inventory issue compared to what it was in India. So, depending upon the heat waves and the weather patterns, the growth will be there. But the inventory issue was not material as far as the international markets are concerned.
But when can we start expecting a significant contribution from the international market to the EBITDA?
So international markets have already contributed significantly even in FY22, isn't it? As all the figures have shown.
I'm talking about in terms of growth rate, sir, not the exact numbers.
Yeah. So it will continue to drive the growth, except some of the headwinds which we are witnessing in some of the countries. So as we mentioned in earlier highlights, we are closely observing them, but we believe that we are relatively well positioned. The reason being, we do have really the strategic advantage of cross-country, very agile supply chain. Due to our full-fledged operating subsidiaries in the respective country.
But if you're talking about growth rates, I think we must recognize that these are all very mature economies, and there the growth rates in general are nowhere close to what you will find in sort of developing economies like India. So I think that the expectations have to be sort of different. However, see, Australia, our market share is, as it is, about 30-35%. Mexico also is about 35-40%. It's only in the US where our market share is relatively low, but it's a huge market, so the upside is significant, and which is why we have grown significantly in the US in the last 2-3 years. We will keep on growing, in the US market, in Mexico, and Australia. The expectations of growth, even at our end, are not, huge. And China, of course, has been, badly affected, where there is no growth. I mean, there is negative growth in China in the last 2-3 years. So all in all, I would say the bright sort of star on the horizon is the US market, and bulk of what you have seen is rebound in the profitability also for international from international markets is largely driven by US.
We talked about the developing economies. So how much is your presence there in, say, countries like, say, Indonesia or Thailand or Malaysia?
Not much. We are exporting, to various countries, but the bulk of the business is coming from, from where we have physical presence, which is, US, Australia, Mexico, China, and now increasingly Brazil, where we have established a sort of a greenfield subsidiary a year ago.
So aren't these countries which I talked about in Southeast Asia, should be there on your radar, considering India-like situations?
Yeah, they could be, but there are various other factors that play over there, which are probably too many to get into over this conference call. So you're welcome to come over. You haven't been to our office in a long while. Please, you're welcome anytime. We'll explain to you, in more granular detail when you do.
Not anything on the horizon as of now.
In Southeast Asia?
Yeah.
No, things are going on, but nothing specific. No.
Okay. All right. Thanks a lot.
Thank you.
Thank you. Our next question is from the line of Devesh from DS Investments. Please go ahead.
Yeah, hi. Good afternoon. Congratulations for a good set of numbers. My question probably is a little more longer term aspect. The Symphony, which many times is referred was a very high growth engine till certain year 16, 17. Now we have very big base, and in the last answer you sort of alluded that we have a sizable market share in majority of the geography that we operate. If you have to sort of see next 3 to 5 year growth, what would be the right way to look at it? If you can help more directionally and broader range, just to understand, how you look at it and then how we should model, that would be helpful.
So, as far as India is concerned, where there still is about 70-75% of the market is dominated by the unorganized sector. There I would say there is significant headroom for growth. And although our market share of the organized sector would be whatever 40, 45%, 50%, but of the total size, of the total market, including unorganized sector, it is still sort of in the low double digits. So there is significant headroom for growth, and we are seeing, in the last 2 years, some sort of accelerated transition from the unorganized sector to the organized sector. So I think India still has significant upside in the household cooler segment. As far as industrial coolers are concerned, where we are still sort of, I would say, our numbers are still very small, and the market out there, the potential market out there, the undiscovered market out there is enormous. So I think that is also something which, and in that segment we are continuously growing. So there too, I would say there is significant upside for growth. And outside of India, maybe like I said, Mexico and Australia may not have very, very impressive rates of growth, but newer geographies like the US or Brazil are where we are I would say, planning on growing significantly in the current year as well as in the years to come. And then, of course, there are other geographies where we don't have a significant presence, but where the potential is huge. And all of us would have read about the heat wave that's cutting across Europe, as we speak. So that is also another big sort of, I would say, frontier that we have yet to sort of conquer, and where we've been around in Europe for several years, but in no significant measure. But we are going to be sort of changing our approach and ensuring that we build a robust business in Europe as well. So I think the newer geographies outside of India and within India, the industrial, or as we now call it, the LSV, large scale venti cooling segment, and of course the household cooler, where we still have significant headroom for growth. So broadly, this is how we look at our sort of opportunity going forward.
Sure. No, thank you for that detailed answer. If I can, sort of add to it, would you also be open to some inorganic elements like we have acquired and turn around the companies? Are you also looking at some opportunities which could be pursued?
So very honestly, we are not actively looking at any opportunities. Even in the past, we never actually were looking for opportunities. These opportunities, I mean, the acquisitions that we have made were opportunities that came to us. So, we have never been looking around, scouting around for acquisition opportunities. So if something compelling comes along, and we keep on getting, offers of all kinds, but unless something compelling comes along, we will not, just go ahead and sort of exercise that option. But we are open.
Yeah, makes sense. And the last one, if you can answer. So let's say, today if we are at a base of X, next 4 to 5 years, right? Would it be reasonable to assume that on the current sizable base, we could sort of double ourselves or probably, be around that? Is that a reasonable assumption? Assuming next few quarters could be here and there, but just 4 to 5 year horizon, what would be your outlook, if you can share?
You get the question.
Yeah, so I believe your question is, can we double the size in next 4 to 5 years?
Right.
Yeah, I think maybe 1 year or 2 year here and there, but I think that's why we are in the business and we should be.
Okay. Thank you. Thanks for the answers.
Thank you. We'll take our next question from the line of Aditya Bhartia. Please go ahead. Ms. Aditya Bhartia, could you please unmute your line and go ahead with your question? Ms. Aditya Bhartia, I request you to please proceed with your question.
You want to move on to the next person?
That was the last question. Back to you, sir, for closing comments.
Great.
Over to you.
All right.
Okay. So thank you very much to all the participants and also to Investec for hosting this conference call.
All right. Bye-bye, everybody.
Thank you, members of the management. Ladies and gentlemen, on behalf of Investec Capital Limited Services, that concludes this conference. Thank you for joining us. You may now disconnect your line.